Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
So I'm not sure this week could get any better. It's a short work week, check. It's Thanksgiving, double check. And then we have rates falling for the third straight day. That is a triple check for obvious reasons. Welcome, everyone. Wilmington Mortgage. I am the aforementioned host of this podcast. Tyler Cralle, of course, loan officer, Town Bank Mortgage right here in Wilmington, North Carolina. We, of course, break down what is happening with mortgage rates every single weekday, and we try and do it in 15 minutes or less, or your money back. Just to give you a heads up, we are 3 days away from Thanksgiving. And then, of course, also, that means 30 shopping days left in Christmas. So make sure you're getting that shop. I guess that's not as big of an issue as it used to be, right? Because everyone does Amazon stuff now. So how many shopping days are left? That was like a big thing I remember growing up. It was like, how many shopping days? And you got to make sure you get to these stores. And, you know, if you're shipping things, it was way more involved from a logistical standpoint. So things have definitely changed. I'm going to hang on to that, though, the shopping days thing. All right, so rates fell. Third straight trading day, Thursday, Friday, and then today. They fell about 3 basis points to close the day. The 10-year yield at 4.03%. That was down 3 basis points from Friday, and the 10-year yield is now down 13 basis points in the last 10 days. I will take it. We're now at the lowest level since before the Fed meeting. Before it was after the meeting or the day of the meeting. Now the best before the meeting. And Mortgage News Daily has the 30-year fixed at 6.32%, down 2 basis points for the week, and the lowest level in almost 2 weeks. So why did this happen? Well, it's because we could be getting a Christmas in December. Come on, that's funny, right? That's where's my rim shot? Hold on. You know, people are always like, oh, Christmas and Christmas is actually in December. That's okay. So it looks like we're going to be getting a rate cut in December. I cracked myself up. We heard last week, actually, from New York Fed President John Williams, which I'm glad we didn't talk about in the last podcast, because today we had the San Francisco Fed President, Mary Daly, basically back up what John Williams said on Friday. So the last podcast, I attributed the drop that we saw in yields to consumer sentiment, which played a part, but it was also the comments that were made by New York Fed President John Williams. I did kind of miss that. I will admit it. It happens sometimes, especially on a Friday. I might miss a story or two. So Williams said on Friday that he fully supported the last 2 rate cuts and sees, quote, room for a further adjustment in the near term to, of course, bring the policy rate closer to neutral. Now, investors interpreted these remarks as a near green light for another rate cut at the December FOMC meeting. And while Williams reiterated that restoring inflation to 2% remains imperative, he explicitly balanced that against risk to employment, saying, quote, it is equally important to do so without creating undue risk to our maximum employment goal. So he's saying, listen, he's answering this question. This is the question that we have had. What's more important? What is the bigger concern? A deterioration of the labor market or a reacceleration of inflation? And what we're hearing from Williams is it's a labor market. And like I said, that was echoed by what we heard today from the San Francisco Fed President, Mary Daly, who followed this argument and argued for a December rate cut because, quote, she's not as confident that we can get ahead of it, talking about the labor market. I meant to say that. So she's saying, hey, listen, you know, this is what she is more concerned about, is the labor market and making sure, you know, it doesn't deteriorate anymore. She described the job market as vulnerable enough now that the risk is it'll have a non-linear change, which is basically Fed speak for a sharper than expected deterioration. Daly also downplayed the threat of a sudden inflation reacceleration, noting this year's tariff-related cost pressures had been more muted than anticipated. So her argument is that, like Williams, it's not that she's not concerned about inflation, it's that she's more concerned about the labor market. And so to have someone like John Williams and then San Francisco Fed President Mary Daly make these arguments kind of back to back, it's really changed things for markets. So they are now seeing that December cut as being likely. And in fact, the CME Fed Watch tool now puts the probability of a December rate cut at 81%. That is more than double where we were, almost double where we were last week when it was at 42%. So at one point, I want to say about a month or two ago, it was 90%. It then fell down to 42%. And now we're back to 81%. And the fact that we're not going to be getting kind of a full picture of the jobs market before the Fed meeting, you can see them sort of erring on the side of, okay, there's a lot of data out there about concern about the labor market. There's not as much data about inflation. Now, of course, tomorrow we're going to be getting a PPI report, our first one in, almost 2 months. And if that's bad, if it's just like horrifically bad, maybe you could see a change. Like if it jumps like 2% in 1 month, which would be nuts. Something like that. Otherwise, I think they're going to say, hey, you know what? We are more worried about the labor market than we are inflation. Now, it should be noted, obviously, bond investors care about the labor market to some extent because that affects the overall economy and that, has an impact on everything. They are much more concerned about inflation. So they're not like the FOMC. They're not like the Fed. And so the fact, they're more worried about inflation. And so you could once again see this kind of convergence or divergence, I should say, of what's happening with the Fed funds rate and what's happening with Treasury bonds, specifically the 10-year. Not saying it's going to happen, but if there is any evidence that there is some concern, like say PPI, you could see those yields move in different directions is my whole point. So good news, though. We are going to be seeing this. It looks like it's now 81% chance of a December rate cut. So going into holidays, going into 2026, good news for markets, bond investors, and, of course, those looking to buy a house, assuming inflation isn't a problem. That is the one concern. All right. I mentioned this yesterday. There was a piece in The Economist, I guess it was a couple days ago, maybe 5 or 6, almost a week ago, about concern. And the headline was actually pretty crazy. So the headline was, America's huge mortgage market is slowly dying. And of course, I saw the headline and I said, all right, I guess I'm going to have to find another line of work. I was expecting to read this article about just how, the way we've always done mortgages is about to change. And oh my gosh, it's going to be this horrible thing. And that's not what was it about at all. The premise of the article is that there's a concern about the mortgage markets. And it's not that concern. I know what you're thinking. It's not that concern. I know you've been seeing people on YouTube and on TikTok and Twitter and Facebook, and they've been telling you for 5 years now that this is the year that the housing market's going to crash. 2008 all over again, 2008 2.0, whatever it may be. But here is what The Economist said. So it pointed out things have actually never really been better. Now, I know there's some stats that are coming out about foreclosures rising and people are starting to get concerned, but these stats are pretty amazing. So the mortgage market, mortgage debt now amounts with just 27% of the value of American household property. That is the lowest share in 65 years, meaning homeowners have never been so flush with equity. Ever 65 years we've seen it that low. And that's kind of a big deal because I'm trying to do the math in my head here. 1948 is when we had, so it wasn't long after the creation of the 30-year mortgage that we saw that number. Then it's gotten worse. And now here we are again. Total U.S. mortgage debt is 44% of GDP, almost a 30 percentage point drop from where we were in 2008. So anyone that tells you 2008 all over again, show them those stats, please. But what they're talking about in this piece is not a concern that we're doing 2008 all over again and lending money to people that can't afford it. No. They're actually arguing we're making it too difficult for people to get mortgages. We actually overcorrected from 2008. The Economist notes that in 2003, 35% of mortgages went to borrowers with credit scores below 720. During the peak subprime era, 2004, 2007, that climbed to 45%. Today, 22%. 22%. That's why that report that came out about Freddie Mac, getting rid of the 620 credit score, it's like that person is not the concern. The bigger concern we're having is someone who's at like 700 or 710 or maybe just under there, not someone who's like at 580. Oh, we're going to drop that. We're going to get them. No. The bigger concern is people who are in that sort of middle score area that have just sort of been cut out of being able to get a loan ever since 2008. And they mention that if we had been able, let's just say instead of that 22%, we declined to 25% and just held out there. So once again, well below where we were in 2003 and well below where we were during the housing crisis. If we just had that extra 3%, that'd be $1.6 trillion in additional mortgages. That's a lot. What is that? I'm not going to do math off the top of my head. I think it's 400,000 potential loans on like a $400,000 mortgage, which would be a high level mortgage. So it's a lot is the whole point. We're running out of time, but I'm going to post the Economist piece in the link so you can check it out because you really got to read this thing. And I know it is paywalled. Unfortunately, I can't do anything about that. But it's also in the newsletter. I kind of break down some of the stats if you want to see them. But basically, they're asking this question, which is, did we overcorrect? No one is saying we got to go back to 2007, 2008 lending standards, no doc loans, stated income, interest only ARMs, that we're adjusting every year and you qualify at the interest only. No. No one's talking about that. We're just talking about loosening lending standards because one of the big things they get into is that the fact that we could potentially have $1.6 trillion in additional mortgages, which that would be added demand, which would be encouraging builders to build. Right now, you're hearing a lot of builders are, tariffs are hitting them pretty hard, but also they're kind of waiting on the sideline because demand has fallen so bad. 30-year lows for mortgage demand. And so why would you build? And so it's like without that demand, you're not going to get the supply. And the fact that we're 3-4 million homes underbuilt, there's your answer. And so that's one of the arguments is that we get more people into the housing market. It encourages more builders to build, get more supply out there. Versus because they're already technically in the housing market. A lot of them are renting. So it's not like we're pulling them from, out of thin air and they're going to add all of these. No. They're already there. They're just renting instead of being able to buy. So I highly recommend you read the piece. Very interesting look at what is happening with the mortgage markets. And like I said, the fact that we are now too safe and overcorrection from where we were in 2008. All right, you guys enjoy your Tuesday. Let's hope that another good day for rates. And we'll be back Tuesday night for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.